Welcome to FinScale, a podcast created by Solen Niederkorn, shedding light on innovation in finance, banking, and insurance.
From Goldman to VeArc, scaling by the books. Gaurav, Bhandari, managing partner of VeArc Capital.
We really architected the firm with just a different idea than what I see conventionally practiced. But then as we started to build out the firm, we made a very strategic move or investment, which is we created a subsidiary called VeArc. And the idea behind VeArc was really to provide a set of capabilities to our portfolio companies that would help them accelerate growth cost efficiently.
After a career at Goldman, Gaurav launched his private equity firm to scale companies with gold nugget products. Together, we dissect the concrete value contribution of this New York-based investor whose partners have extensive CVs. Gaurav discusses VeArc, a subsidiary of VeArc that provides support services to large portfolio companies at cost. We revisit the three pillars of scaling in a well-processed manner. The reason why I invited Gaurav is precisely for this scaling process by the book that VeArc has implemented with its team, as well as its advice from world-renowned industry leaders. Enjoy the show. Hello, everyone. Hi, Gaurav.
Hi.
Super happy to have you on my podcast. Thrilled to dive into private equity. You know, it's an asset class that I really love since, years. And I discovered VeArc Capital when I recorded a few weeks ago Martin, the co-CEO of Scalit, and he told me a lot about your firm and what you were, implementing and the way you were supporting those companies. So I was super happy to discover this into more details to prepare this episode. I ask you to quickly introduce yourself and tell a bit about your professional past and your career prior to launching VeArc Capital.
Thank you, Solen, and thank you for having me here. And it's my pleasure to be speaking to you and your audience. Before starting VeArc, I spent 26 years at Goldman Sachs, and I was there and served in a variety of different roles. I started because I was an engineer by training, as a quantitative strategist for our capital markets and derivatives business, and then moved to investment banking, where I banked the financial institutions industry, also the natural resources industry. Then the second half of my career was in a variety of different investing roles. I was a proprietary investor for the firm, where I led a group that made public and private equities investments. And then I was also a fund manager. So a long career there. And as I thought about what I wanted to do for the next phase of my life, I thought I would be inspired by the many entrepreneurial journeys I had been a part of and try to start my own.
Excellent. Because it was quite a nice career and you could have continued for years. So what was the trigger? Did you have a specific conversation with one of your friends, or did you have a moment where you realized that you wanted to move forward?
It wasn't a specific conversation. And for things like this, I often feel your heart knows before your head. And, for a couple of years before I left, I had been thinking about what I wanted to do for the second half of my career. Retirement didn't have much of an appeal to me, and I felt I already had a pretty good job. So it wasn't going to be another job. And it's really, I think the idea that appealed to me most was build something that I would be very happy to work at for the rest of my life. And so that was a lot of the thinking. That was a lot of the thinking behind building VeArc, or maybe the lack of thinking behind building VeArc.
And why did you focus more particularly on growth rather than VC, for instance? Why did you choose to move in that specific direction?
At Goldman, I had the great good fortune of investing in a variety of different genres. So I've done some public investing, I've done some venture investing, also some LBO-related investing. And I think net, I just liked the risk reward of growth equity, or what I call investing in scale-ups. I think the risks associated with venture are different. They can be lucrative. But to my stomach, the idea that a company has found early stage product market fit and now wants to become a category leader that, to me, offers the best risk reward out there.
And did you choose one specific industry? You told a bit about finance, you knew well. What was initially the strategy and the vision you had for Long Arc?
Instead of I picked a few verticals, but really what's important was that we picked a horizontal, and the horizontal was that how is technology changing businesses? How are the companies of the future going to disrupt incumbents, leveraging technology? And so that was kind of the general idea. And the industries we focused on were industries we knew very well. We knew the financial services industry, having lived in it and invested in it. We knew generally the professional services industry quite well. And, I'd invested in media and things like that, but we haven't really found anything that compelling there. So we've ended up with most of our investments in financial services and professional services.
Mm-hmm. And what is, in terms of ownership, what kind of target do you generally identify, and what kind of ownership do you co-invest? Do you invest with VCs? How does it happen?
We, for the type of investing we do, we seek to buy majority equity stakes in businesses. Mm-hmm. And so we don't co-invest, and we don't invest with VCs, though occasionally there might be a VC in the cap table, but there rarely is. I think we're really looking for businesses that where the backstory is a founder inspired by an idea, puts together a team, spends a few years going after a market opportunity, finds this elusive thing called product market fit, and needs capital, but he or she also needs resources, expertise, capabilities to scale. And almost every business we have bought, has been outside the Silicon Valley ecosystem. Mm-hmm. And roughly about half of all companies that get created in America are outside the Silicon Valley ecosystem. So it's a pretty big hunting ground.
How identify those targets? Do you have some engineers internally screening the different sectors, screening companies, watching companies evolving, and scrapping all that data and producing some list? How does it happen concretely?
We are a research-led investment firm. And so any given week or at any given time at Long Arc, there are multiple research initiatives underway where we might choose to say, look, how is software changing the insurance industry? And that might be a horizontal research project we might do. But then we might very quickly, after we do a horizontal analysis, start to dive deeper into narrow verticals. Well, how is software affecting specialty lines insurance industries? Or how is software potentially going to change the claims management process? And once we start to see if we've identified a big market opportunity, we try to map out the landscape. Who are the players? Who's got an advantage? Who's got a great product? And then it's really brute force, reaching out to all of them and building a dialogue and identifying if we can find somebody that we want to invest with. It's a long process. I mean, we typically, from having an investment thesis to completing a transaction, is probably 18 months for us. Mm-hmm. But we're not trying to do a dozen deals a year. We try to make 2-3 investments a year.
Can you tell us a bit more about the investment life cycle? So those 12-18 months to identify the targets and invest. And then you have this period where we will dive into this in a few moments, where you help scaling the business. And then the exit, how long does it generally last?
Typical journeys for us are probably going to be centered around 5 to 7 years, and probably on the north end of that scale. Once you've identified a company, typically our diligence takes time. We tend not to use bankers, brokers, advisors. We proprietarily sourced every investment we've ever made. And so in the process of getting to know the company, we build a dialogue with the company where as we're learning about the company, we collectively try to write out what we call our ownership plan, mm-hmm. Where we are trying to imagine what this business could be and then lay out in some very concrete terms what it'll take to get there. And it's a process where you then try to find alignment with the then owner or the current owner of the business. And we feel like that's a good way to end diligence, which is to come away with a clear plan of what you want to do were you to buy this business. I would say after we close on a transaction, I think about our ownership as really in three phases. The first phase, perhaps the most critical one, is what we call the foundation building phase. And that's generally between 1 and 2 years. A lot of what you're trying to do then is recruit the right talent, to put the right person in the right seat in the organization. And usually the companies we buy have gaps, have talent gaps. So they need to be identified and people need to be put in place. Two, it's not just about hiring the people, it's about building the organization, creating the right processes. Most of these companies, before we met them, were startups, and the startup mode of operation is very different than the scale-up. Most of the companies will go from 10 or 15 people to probably 50 to 100 people, sometimes even more. So how do you recruit quality talent at that scale? How do you organize it? How do you build a culture where people can strive towards excellence? How do you get everybody aligned? So I think that's one. I think the second thing is, we invest in businesses that are product centric. And so a big part of what we try to do in the first year is lay out or think through what our product strategy is going to be. Mm-hmm. And really then try and build the underlying product and technology organization to execute on that strategy. Mm-hmm. So I would say that's a big part of what we will do. And then finally, implement processes. It's simpler said than done to make sure that there is rigorous application of Scrum methodologies. There's high quality marketing motion or a go-to-market motion. So I think that all that takes time. And for us, sometimes it takes as much as 2 years, and it never really ends. But that's phase one. I think the phase two of these businesses, if you've done a good job in phase one, is where you start to accelerate revenue. And that's really about then optimizing your go-to-market motions, if you will, or your go-to-market organization. And inevitably, if you're tasting success, the product also needs to evolve and should evolve, and you help product evolve. And then I would say the last phase is where you start to think about, well, how do I grow profitably? And that's the stage just before you're starting to exit, because from the audience that wants to buy these companies, that's what they want to see, mm-hmm. right? Companies that have scaled well and are now enjoying profitable growth. So that ends up being our investment life cycle.
And which area would you say is the most complicated to scale? Is it finance, products, ops, hirings, HR?
I mean, I would say recruiting the right talent and building the culture, the necessary culture, by aligning that talent, implementing best practices or processes is hard. And it requires real leadership and processes and ownership and a real investment in time. So we spend a lot of time on that. I think that's part one. And I think the second part that we feel is key to everything is to get the product right. If you build a great product, you have the best chance of delighting your existing customers. And if your existing customers are delighted, then their stories get amplified through marketing, and selling becomes easy. I mean, our estimate is that half, if not 3/4 of every sale is really about talking about your reference customers or customers who serve as references for you. So there's a waterfall or there's a consequence chain that you try to execute on. Start with the talent, build a great product, make your customers happy, amplify their stories, and sell effectively. So I would do it in that order.
And how did you build your team internally to help accelerate on all these different pillars that you mentioned? Because it seems that it requires a lot from your side of support if you help businesses to scale, if you help hirings, So first, how did you organize internally? And practically, if you could take one example of a company where from investment to exit, how did it concretely happen?
Like the day one philosophy of building the firm was to be an active investor owner, an engaged investor owner. And that was one of my key learnings from my time at Goldman, where I think we've focused more on investment selection, perhaps less so on ownership. And I came away thinking that in this next stage, I need to think about ownership as a profound responsibility for investors. So when you kind of have that as your North Star, you architect the firm differently. So in choosing my partners, I chose people that had operating experiences, that had experiences that would complement what I knew or what experiences I had or what skills I had. And, my 5 other partners each brought 25 plus years of experience into the company, and they'd served in a variety of different roles as CEOs, as CFOs, as COOs. So I think we had that mindset. We organized the rest of the team. Most private equity firms will set up a investment team and an operations team or an ownership team, and we always felt like that almost creates 2 classes of citizenship, and we're going to just go with an integrated investment and ownership team. To be a good investor, you need to be a good owner, and vice versa. Mm-hmm. So we really architected the firm with just a different idea than what I see conventionally practiced. But then as we started to build out the firm, we made a very strategic move or investment, which is we created a subsidiary called VeArc. And the idea behind VeArc was really to provide a set of capabilities to our portfolio companies that would help them accelerate growth cost efficiently. And VeArc does a lot of different things for our portfolio companies, but really there's really 2 buckets of activities. We built centers of excellence where we provide expertise in marketing, in product, in recruiting on a fractional basis to our portfolio companies. That's all they need.
It's like an operating partner, something like that.
Well, a bit more than that, because it's not an advisory business. VeArc is, they're doers. So this isn't about just telling people what to do or even showing them how to do it. It's actually helping them do it. Mm-hmm. So maybe the better parallel would be a fractional CMO or a fractional CPO, people who roll up their sleeves and do things. Mm-hmm. But without having to pay the markup of working with fractional firms, mm-hmm. Right? We do all of this for our portfolio companies at cost. And then the second thing we did at VeArc, which has been a real game changer, was most of our companies struggled with recruiting talent locally. Almost always were offshoring some of their technology development, but doing it in a disparate way, often working with vendors that weren't necessarily delivering the quality they needed or were as reliable as they wanted them to be. The problem was that each of these companies individually was subscale to be able to really engage with high quality outsourcing or offshoring firms. But collectively, we felt we had enough of a critical mass that Longar could facilitate this. And so we set up a facility in India where each of our portfolio companies now has a pod of talent where they recruit developers, operations people. Almost all of our portfolio companies now develop software using hybrid squads. Mm-hmm. It gave our companies the ability to recruit high quality talent in a cost effective way, perhaps faster than they could have here, but also cheaper. And in almost every case, the resulting squad was a more productive, better squad. So that was a real game changer. So as you can see that, ownership has many facets or many dimensions. It starts with how you diligence. It's how you think about your investment life cycle. It's what you actually deliver. And I'll say one other thing. When we put ourselves in the shoes of our founders and management teams, I think the context with which they are building their businesses doesn't necessarily always give them the range of experiences and skills they need to build a business, right? They see a great market opportunity, they hustle to go after it, they build a product, they find product market fit, but they haven't really thought about what a great product and technology organization looks like, what a successful go-to-market organization looks like, what are the best practices in customer success, how to think about capital allocation. And so that's our job. We've gone through this journey before. We know what best practices are. We don't need our portfolio companies to discover what's good. We can tell them.
You save time.
Yeah, and that's a big part of it.
Can you illustrate this with one example, just taking maybe 2-3 minutes, explaining to us from where it was when you started investing till the exit and the type of exit that you made on the company?
Sure. I mean, I can pick an example of a company in France. We invested in enterprise software provider for credit-related specialty line insurance companies called Tinubu Square. We invested in September of 2017, and at the time we invested, the company had one product, about 6 customers, and from which it was earning, mid-single-digit annual recurring revenue. I mean, it was a market-leading product. They were winning the vast majority of their RFPs. Their customers seemed to be delighted. They faced virtually no competition. They had 10 plus years into product development on the back of all of their customers. It was a very evolved product. It was a market-leading product. It felt like a large market opportunity, but it was a classic setup for a scale-up, right? They hadn't, the 2 founders who had built this business, were just real leaders in the industry. They wore many hats. They were the chief salespeople. They were the chief technologists. This is often the case. And now the question was, how do you build an organization? How do you scale? So you fast forward 6 years later, that one product is now two products, one for trade credit, the second one for bonding and surety. The 6 insurance company clients are now almost 35. The annual recurring revenue has scaled almost 5x, close to 6x since the time we invested. But that's really on the back of building an organization, articulating and executing on a product strategy, doing some accretive M&A, do all the things that, companies need to do as they grow up, right? You can't be all grown up when you start, but at some point you need to grow up. And we haven't exited a business yet, but what we have today is a market-leading company that has CAGR'd for us just under 30%. It leads both of its product categories, and by the time we exit, it'll also be a profitable business. And so I think that's what everybody wants to buy, right? Strategics want to buy profitable businesses that have grown rapidly and are market-leading, but so do financial sponsors. And if you tee up that, you'll generally have a good outcome.
And how do you enhance financial discipline? You were telling us about the third part after scaling, ensuring that the business have sustainable growth.
I think it's a mindset more than a tactic. And I think you need to have it on day one. And I think it's hard because we live in a world where we're shaped by what we see going on around us. And we've lived in market environments which emphasized, even rewarded growth at all costs. But then inevitably those periods of time come to an end. And then you kind of go to more sober market environments where people talk about capital efficient growth. And I think in my experience, it's not easy to pivot from one to the other. And I think you got to sail your ship with a mindset that balances growth with cost discipline. So I think that's one. I think its mindset is important. And I think it's discipline where you'll see your competitors throw money at the problem, but you just have to have the experience, if you know, or the maturity to know that that'll generally not work. Even though at that moment it feels like you're losing and they're winning. I think the second thing is, I think you have to really create rituals and processes that emphasize the cost discipline that you need to operate with. I think don't think of cost discipline as a reactive thing because the world changed, you're running out of money. Think of it as a proactive thing. So it's very closely related with the idea of a mindset.
Mm-hmm.
And so we will, with every single portfolio company towards the end of the year, do a very comprehensive zero-based budgeting exercise.
Mm-hmm.
Right? How can whatever we do, can we do it more efficiently if we were building it from scratch?
Mm-hmm.
If we were deriving the answer from first principles and then look at the bridge or the transformation or the process reengineering we might need to do.
Mm-hmm.
Because growth, at least in our experience, tends to be chaotic. It's not organized. It's not, you see a market opportunity or you get a client, they need you to do the impossible. And an entrepreneurial company will try and do the impossible. But in doing the impossible, you'll take shortcuts and you'll compromise, and that's okay. That's just how life is. But then I think from time to time, you need to step back and say, no, I need to really go back and clean it up and build some basic foundations so that I can scale better going forward. So yeah, cost discipline is a mindset. It's a set of proactive activities. And it's also constant vigilance. If you talk about something in a regular way, it's your culture.
Thank you very much. One last word for the conclusion of my episode. I always ask my guest book recommendation because I'm a huge bookworm. So I eat books almost. So I'm very happy to hear what you would recommend to us.
Well, I, like you, I'm a pretty active reader. What I've been reading most recently is a fascinating book by a gentleman called Ulak Prasad, who runs a fund called Nalanda Capital. And he wrote a book that's titled What I Learned About Investing from Darwin. And for those of you who have read Richard Dawkins' Selfish Gene, he picks up from right there in terms of how that sparked a curiosity and how he sought to see parallels for what was articulated in that book in investing. And he does, at least to me, because I'm also a student of this subject. I haven't read it all the way through, but I'm finding it a fascinating read.
Thank you, Gaurav. That was very interesting, and thank you very much for your time.
My pleasure. Thank you for having me.
Thank you all for listening and sharing this moment with us. Don't hesitate to contact me on Twitter or LinkedIn to share your comments and reactions. You can also rate this episode on your favorite podcast platform. See you soon.